All right, guys, so if you're getting a low down payment loan program with less than a, let's say, 10 to 20% down payment, with the exception of VA loans, you can pretty much bet that you're going to have an additional monthly payment expense called mortgage insurance. Now, you might hear of private mortgage insurance, PMI for short, and you might also hear the term mortgage insurance premium, or MIP for short. So these both really serve the same purpose, but to clarify, private mortgage insurance is technically for conventional loan programs, as their mortgage insurance is provided by third-party providers. For FHA loans, on the other hand, the loan product is actually a government-backed loan, and the mortgage insurance is structured differently and is not private, and this mortgage insurance is usually referred to as MIP for your mortgage insurance premium. For general purposes, we'll refer to both of them collectively as MI for mortgage insurance. Now, what MI essentially does is it protects your lender in the event that you stop paying your mortgage. Now, due to pretty strict underwriting, most borrowers don't stop paying their mortgage and go into default. However, statistically speaking, the amount of money a borrower has invested in a property does correlate into their risk of default. Because think about it. If a borrower runs into hard times and has a $100,000 amount of their personal savings invested into a property, then they're going to probably think long and hard and search high and low for any available options to them before they decide to give up on making the payments and lose that money. Therefore, if you're taking out an FHA loan, for example, which only requires a 3.5% down payment, you'll be required to pay MI. It works just like any other insurance, except that although you're the one paying for it, your lender is the one that benefits in the case that there needs to be an insurance claim. Make sense? Now, the cost per month will vary depending on the number of factors, including the type of loan, the relative size of the down payment, and the loan balance. And there are also several types of MI, all right? Using the FHA loan as an example again, this type of loan actually has two mortgage insurance types in the same loan. These are upfront mortgage insurance, which is essentially paid upfront alongside with closing costs when closing on the purchase. And the second is the regular annual mortgage insurance paid in monthly payments. Additional types of MI, primarily for conventional loans, are borrower paid, lender paid, single premium, and split premium. And real quick, I want you to understand that when it said that a lender is paying for something such as lender paid PMI, just remember that whatever they are paying for comes with a cost. So while some lenders might advertise a low down payment loan program with no PMI, what they really mean is a loan program where we are buying PMI on your loan on your behalf and charging you a higher interest rate to cover our generosity. Back to the other types. Borrower paid is just what it sounds like. This is the typical monthly MI, most common with low down payment conventional loans. Single premium or single payment MI is where you are paying for MI in a lump sum upfront as opposed to monthly payments after closing. And then finally, split premium MI may be a combination of both single payment and typical borrower paid monthly mortgage insurance. Your loan officer will be able to explain the type of mortgage insurance required for your specific type of loan and the monthly amount you can expect to pay. And if you're wondering if you'll be paying MI forever on your loan, the answer is it depends. If you get an FHA loan, for example, in most cases, the mortgage insurance requirement will always stay with the loan. Now, you can get out of the mortgage insurance, but you'll either have to refinance into a different loan type or simply pay off the loan. Conventional loans, on the other hand, are supposed to have the ability to remove PMI requirement if either A, you pay the balance down to be at least 78% or less of the value, or B, the property value appreciates to the point that the loan balance is 78% or less of the value of the property, or a combination of the two. Again, a good loan officer will be able to answer questions regarding your mortgage insurance more accurately as it pertains to your loan and situation.